Okay, guys, that's what we use. That's what personally use. It's one of the sources which I use for fundamental analysis. It's called the platform called Value Line. The reason why I chose Value Line, very simple. When I read the first book about Warren Buffett, he mentioned that he's using Value Line and Morningstar, and I signed up for Value Line. Also because the guy who I learned it from, he was using Value Line as well, and it was pretty handy. Now, if you see here, I'm going to show you, and you're going to tell me yourself, your decision about these companies right now, which I'm going to show you. But look, isn't it amazing that you can see, this is old report, but still, from 1998 to 2014-15 information, like 15 years of information in one page. Isn't it amazing? Some people look at the 1 quarter and they make their decision. And 1 quarter, if you guys running a business, or if you ever involved in business, you probably understand that there is volatility in business activities. I mean, there is seasonality. 1 quarter, like, I mean, if you take even Coca-Cola, when do you think Coca-Cola sells more products? During summer, during winter, right? And of course, if you're taking only small fraction of the business in 1 quarter, it's very difficult to make a decision. But when you see the whole, like, I mean, duration of activity of the business, the decision is made much easier, okay? And the confidence which you're receiving when you're analyzing the business like that, it's also much better. And then you can put more money into that particular business, all right? So that's what we do. Now let's have a look at general how to buy and how to sell the companies. Now, imagine the company went public, okay, and start trading. And this is the first situation. By the way, guys, do you see my mouse? Yeah, I'm showing here. I hope you see it, mouse. So imagine, okay, just checking. Yeah, okay, great. So that's the orange line. It's actually not a line, it's gap, because I told you that it cannot be the exact price. The intrinsic value is varies, right? So based on your opinion. So can you imagine that that's what we see? So this is the thing, okay? It is fair value, assuming that this is a network of certain, I don't know, shops, right? So, or restaurants, let's it be restaurants, right? This is a intrinsic value, so certain amount of assets like premises, equipment, cash on the account, right? So the company is making money, right? So, and this is the price, which represent the stock price of that particular company with 100 restaurants. So next year, assuming that the company grew 10%, so they opened 10 more restaurants, so become 110 restaurants, and also increase 10% of the assets, cash, and etc. So, and the profit also grew. But the interesting thing that very often the price of that particular company on the stock market didn't grow 10%, it grew 20%. So it's moved more higher. So then another year, the company intrinsic value, the fair value, okay, the real value of the company grew again 10%. But the price, which represents it, grew another 20%. The third year, the company grows again 10%, the price moves another 20%. So what happens eventually? We see this discrepancy. We see that the company value is still growing, it's good company, it's growing company, but the price overtook it long way. Much higher. And when people open their trading accounts and when they look at this, how do they make their decision, guys? They usually look at the chart. Nobody sees this orange line. Majority of people see this green line. That's the price. And they say, my goodness, look at this company, how growing faster. And what they do, they jump on it and they buy it at the highest moment. And this company is overvalued. And this is the highest risk ever to buy in this company. Because if that company even has one bad report, only one report, what happens? It's like a bubble. It's burst and the share price starts collapsing, even if it is a good company. If you go, guys, even last year, okay, if you look last year, Facebook at that time was about $220 in price. And it was already overvalued. And what happened? That Mark Zuckerberg was invited in order to face the US government. and they started talking about the privacy issues and etc. And at that moment, the stock price collapsed to $120. The company like Facebook, if you look at their growth, it's fantastic. It's great. It's really like growing, and they increasing sales and revenue from the advertisement, and they introducing new services, etc. But it was overvalued, and as a result, when the problem like that happened, what happens with the stock? Can you imagine how people felt when the stock from $220 went to $120? It's very difficult. Imagine it's $220,000 you put in the stock, you believe in Facebook, and after that it's dropped to 120. It's good that Facebook recovered, right, and now moved all the way up. But a lot of companies, they don't, because Facebook is a kind of publicly faceable company. A lot of people know about this company, so that's why it's so volatile. But there are some companies which on the background. Okay, so for example, recent masterclass we looked at was Vimeo, and Vimeo several years ago it was overvalued, quite expensive. Now it's dropped down. Now it's become undervalued, but it's not going to move as fast as Facebook because people don't know. If I tell you Vimeo, what is it? A lot of you wouldn't know what is it unless the people who made money already after our last master class, right? So this is like that. Okay, the question is, I think today the whole market is overvalued. Yes, correct. Yeah, the whole market is overvalued right now, but still, even when the whole market is overvalued, there are good opportunities there. But you have to be extremely careful when you putting your money there. You have to understand what is going to happen with this specific business if the stock market goes down. All right. Now the question is, guys, why the heck, when the price goes down, why people would sell it below the intrinsic value? Why would they sell the business below the real value? Tell me, why the green line can go below the intrinsic value of the company? Yeah, we understand why they pay more, because they believe the company continue to grow and catch up. But why would they sell cheaper? Do you have any idea? Yes, short-term issues happened. It's the reason for that drop. But why people selling? And guys, I won't hold you, but the main reason, because they don't know where the value is. They have no idea, because they see the price and they see that they bought it for $10 and now the price is $7, 30% drop. They are scared. They believe the company is going to liquidation. They didn't read the financial reports. They didn't read anything about this company. That's why they are so scared. And that's why they do what? They sell it. And people like me, like our club members, we come and we buy it at this moment from them, right? And after that, 4 months later, 6 months later, when the company recovers, we making money and those guys, they're frustrated. Okay, and remember again, people with the knowledge, they're taking the money from people who don't have the knowledge. So which side do you want to be in? Okay, this is very important. Okay, guys, the question for you, is it possible this way? So when the intrinsic value, it's like when the company becomes undervalued, it doesn't recover. Is it possible like that? So is it possible that the intrinsic value, it's also going to go up, down? Does it happen? Of course it does, right? Because if the company lost their grip on the market, and instead of making money, remember that this intrinsic value has two parts. One part is asset level, so it's what you have at the moment, and also the future profit. So if the company from the profitable becomes unprofitable, what happens? They start eating out their assets. So if they have cash on their account, they're going to spend it because they have losses, right? So, and the amount of assets also goes down. And of course, the company goes down, down, down. And that's where you have to understand what's the problem issue there. And there are a lot of companies like that. And you probably know that, for instance, last year, a lot of industry were affected. For example, airline industries like Boeing, they reported last night huge losses. And guys, we could predict that because we understand that all planes are parked. People are not flying anymore. Only small fraction of planes are flying there. And of course, the whole industry is suffering. So, and you don't have to be like 200 IQ level. You understand that, and you understand that all those companies, they're going to report very bad quarters. Okay, so you could sell off it earlier, or you could protect yourself using hedging strategies. So, but a lot of people, for whatever reason, they hope that it's going to recover. It's not going to recover unless all these restrictions are lifted. Okay. Now, the next part, I am going to ask you, okay, to help you out. Guys, think about it. You have $10,000, and a friend of yours came to you and said, look, I have 3 companies, I know them, and where will you put money? So we'd say Ford, you know, yeah, manufacturer of cars, CNC, Centene Corporation, and Hershey, they're making chocolate. Centene Corporation, what they do, they provide a health care for Medicare, for not private sector, it's more like a public sector. They provide all this health care in the United States. So guys, the question, which share will you buy? Okay, which company will you invest? In which company you won't invest? Okay, JCNC, need to analyze first. I can eliminate Ford for personal reasons. Okay, any other opinion, guys? Put it there. It's very important to learn when you're dealing with stock market to make your decision, to express your opinions. It's never wrong or right, because if you do wrong, like opinion, it's not bad. I mean, it means that you need to learn something about it. Now, Olga answered correctly. Out of everyone, yeah, and Mick as well now, you need to analyze it first. This is a tricky question because the answer has to be here. We cannot make the decision unless we see what? Financial statements, or we analyze the company first. So, and let's have a look how we do it. I'm going to show you 3 reports, one for Ford, one for CNC, and another for Hershey, right? And then you'll tell me again which company you're going to put money in, right? At the moment, we're looking just the strength of the quality of the company. And this is the most important part, right? So maybe we don't identify the price at which you're buying, but can you imagine, will you put money in that business or not? Okay, this is the main important questions which you're having right now. So let's have a look. I'm going to show you this statement which I'm using, and that's what I do on a daily basis, okay? And this is Ford. And guys, the first line here, you see in the table, that's what we see. So revenue, it's a sales level, how much company is selling per share. It's just easier for you to understand. So look, in 2004, the company was selling $93 of products for 1 share. Okay, then you can see a lot of fluctuations. Now it's selling $32 for 1 share. So what happens with the amount of sales level? Did it grow up or did it go down? So you can see that even within last, would say several years, from 2017, from $39, it went to 40, then 39, and now 32. Okay, so what happened? So if you're looking at the long term, amount of sales they do increases or decreases. Okay, that's one thing. Secondly, as I already told you, the important part is the profit, actually, right? Not only the sales, but the profit, the money which company have after all the expenses paid. Look, here the company was making $2 a share, and now it's making 20 cents a share, right? Last year, it made only 1 cent a share. Before, like, it was 1.8, 1.7, 1.9, 90 cents, $1 cent. So what happened with the profitability of this business? Did it grow up or did it go down? Okay. Another thing, the debt level. So how much company owns to the banks? $156 billion, big number. But now if you go and buy this company, it's only $30 billion. So actually, the company worth on the market less than they own to the bank. Now, it is very important to understand, because can you imagine if you buy the whole company? So if you buy the whole company and you pay $30 billion now, then you understand that you also own to the bank another $156 billion. So the total enterprise cost for you, if you decide to buy the whole company, is going to be $180 billion. Okay, this is, and it generates you, if you look at here, net profit, it generates you $84 million in profit. So the question is for you, will you buy the business like that or not? Okay, so let's have a look at another company. And by the way, it sells pretty cheap. PE ratio is only 10. Okay, it's considered now. Then look at Centina Corporation. Okay, here the company in 2004 was selling $6 of product a share, and now it's selling $191 of services. So what's the growth rate? Remember, there was 90 and then 30. It went from 6 to 191. So look at the last few years: 94, 119, 130, 140, 100, nearly 80, 190. Even during this pandemic time, it's actually increased the sales level. So, okay, the profit is important. Here it was making 26 cents a share. Now it's making $4.70 a share. Guys, what happened? Did it go down or did it grow? Now let's have a look at the last few years. $1.12, 140, 220, 250, 350, 440. This year 470. Next year they are planning 550, 70. So what happens with the company? Now debt level, they have $16 billion of debt and $37 billion in capitalization. So it's half of the capitalization is in debt. Still high, still high. We always look, is it manageable or not? Okay, net profit here, $2.7 billion this year. So you have to ask how many years it has to be in order to pay that debt for them. Okay, this is kind of it. And this is a cash flow. You see cash flow is higher than earnings. Okay, this is, and the third company, Hershey. Look at Hershey, $17 a share sales level here and $38 here. So doubled, right? The profit was $2 a share, now $6 a share, tripled. Okay, the debt level, $5 billion debt, $31 billion capitalization. So the debt level is just 15% here. So guys, now you have three companies. You have knowledge about Ford, and I showed you only three parameters: sales, net profit, and the debt. There are more parameters than that you need to take into consideration. But in order not to take this class very long, even though we're already running 1.5 hours, right? So I presume it's much easier now for you to understand which company to make a decision on. So guys, if you ask you the same question now, which company you're going to put money, which company you're going to buy now? Ford, CNC, or Hershey? Or definitely at least tell me which one you're going to avoid for 100%. Ford to avoid, we'll choose CNC, and Hershey based on other factors, technical. All right, okay, CNC, yeah, absolutely. So of course, there are more parameters than that, and already you can see that Mick, he's a very active trader, and he understands much more than we covered today. But guys, this is the core. That's how Warren Buffett makes their decision. Believe me, Warren Buffett is not going to look at the this technical analysis thing. He's looking at the company itself, and he knows at what price he's happy to own this company. It's like, can you imagine you decided to buy a car? Let's say you decided to buy BMW X4, which I have, right? So, and you know that the new brand car costs like, let's say, $90,000, right? And you want to buy it, and then you can see that somebody just bought this car, and then they were relocated to, let's say, New Zealand, and they don't need this car anymore, and they're selling it. And because it's quick sale, they have to sell really urgently, really quickly. They're selling it for $70,000 or for $60,000. And you know, you're just going to buy it in anyway at $90,000. So what you do, you go and buy that brand new car, which maybe have only 2 kilometers driven, with a 30% discount. So you need to know what you want to buy. That's first thing. And secondly, you know at what price you're going to buy, and then just sit and wait. And the question is, how long you're going to wait? Okay, and the answer is you don't know, because I have some companies in my watch list which I never ever bought for the last 10 years because they constantly run a bit higher in price. I have a rule, I have a strategy, and I don't slip my strategy away. So I always constantly buy in a company which undervalued, and it works for me. Okay. Now, very important question which you have to ask as well, on the top of when the price collapses, you need to understand the price doesn't go down just like that. Okay, it's not just a lucky period for whatever reason, and the price just fell 20 or 30 or 50% on that particular stock. There is a reason for that. Okay, and the reason is pretty strong, and that's why people are afraid and they're selling it off. And if you look at generally what happened in the market, there could be internal reasons which are applicable to that specific business itself. So they could be they messed up with their product, so the quality of the product dropped. Maybe they messed up with their marketing campaign. Something happened with marketing is bad. Maybe something with operation, delivery, whatever happens within the company. Maybe some lawsuits within the company. And there are external reasons. For example, pandemic, right? It's more like ecological, right? Then technological breakthrough. It could be political, okay, sanctions, right? It's any type of legal sanctions, whatever, right? New tax implemented. So external reasons. Guys, if I ask you what kind of, if we just generally look at it, internal reasons and external reasons, which reasons company can influence itself and which reasons they cannot influence? So for example, if you know that company has, let's say, products with quality of the product, can they work on that and improve the quality of the product? If they have bad marketing campaign, can they work on it and improve marketing campaign? So you understand that the internal reasons are kind of more likely to be solvable rather than if you compare with a certain, let's say, pandemic problems. So if the government announced that the quarantine and lockdown and all airlines, now they're stuck, they cannot do anything regardless of their smartness, regardless how creative they are, it's very, very difficult for them, right? I know that in Australia, there was a flight to nowhere. I don't know, guys, if you heard about it. Not, I think Qantas or Virgin, they created it. And you just buy the ticket and you just fly it from Sydney airport, fly around and then come back. I don't know, have you heard it about this? What company did it? And the one around South Pole, no, it's just here somewhere. They flew towards the Perth, 1 hour there, a couple hours there, and then come back just to fly around. People want to just experience that experience again. Qantas did something like this around South Pole. Okay, interesting, right? So you see some companies, they kind of created, but still it's not going to create a profit, like huge profit, you understand. So guys, when we try to find the companies, we look for those for companies which fell in price because of solvable problems. We understand that the price, which was affected by certain problem, would say increase expense level, we understand that this is a solvable temporary problem. It's like explain you, let's give you two examples. Imagine the two companies, both of them generating $1 billion in net profit. So net profit every quarter, okay? And then two companies, and that goes for many months or years, right? So you know that is pretty stable, maybe small fluctuation, but about $1 billion of profit. And the next thing, you know that one company is a tobacco company, and what they do, they export, import tobacco, right, from, let's say, somewhere Italy to Australia, and that's what they want, to United States. Correct. And another company, they're doing the oil pipelines. So they distribute the oil. So other companies which are pumping oil, they go to this company and they go through their pipelines to certain destinations, to their refinery. They have storage facilities. They go to the certain clients, etc. Right? So two companies, different type of business, and both of them, one quarter reports the earnings not $1 billion but $500 million. What do you think happens with the price, stock price, with those companies? Is it going to stay on the same level, or is it going to go down? Especially for guys who already trade in the stock market, you probably understand, right? So if the company reports half of what they promised, the share price is going to collapse a lot, believe me, because sometimes company misses like 2%, 3% in earnings, and they drop in price. And here is 50%. Believe me, the stock price is going to drop like a knife from the table. Okay. But then you're a smart person. What you do, you open the reports and you start reading or listen comments of directors. What happened? And tobacco company is telling you that the governments, they introduced new tax tariffs for cigarettes and alcohol. And as a result, the tax which they are paying now, it's affected the profitability of the company, and practically $500 million now is going to be paid to those tariffs. And another oil company is telling you the reason for this problem and reduction of rate, it was that one pipeline got burst and the oil spilled around in the environment. So they had huge fine from all these government agencies. They have to spend a lot of money to fix this pipe. Also, they lost some revenue because the companies which were pumping oil through this pipeline, they had to use the competitors, right, while they were fixing this. But now they fixed it. They cleaned the area, they plant new trees, they paid all the fines, but it took $500 million. Now, guys, you know this information. What happens with the profit of tobacco company next quarter? Is it going to be $500 million or go back to the $1 billion? And what happens with the profit of the company which doing pipeline? Is it going to go back to $1 billion? Or is it going to stay on a $500 million level? What do you think, guys? That's a business scenario. That's how we analyze it. That's when we see the price drop, we analyze the reason, and we're trying to understand. I believe you understand. If the government introduced new tariffs, they're not going to lift them up. So they're going to run them forever. So it means that company, tobacco company, is affected forever until they go into those tariffs. So that's it. The problem is there, it's a Puritan issue, and it's going to affect their profit forever. And if the company dropped in price, it's not going to recover quickly. Yes, it might recover eventually if the company will optimize their processes, increase their share, presence in the market, etc. But it will take a while to do that. Okay, maybe they will have to increase the price for cigarettes. It will take a while. But the company which had a spill of oil, what happens for them? They fix the problem. That's it. So next quarter, the oil again going to go through their pipeline. So they're going to generate exactly the same profit which they were always doing. So what happens with the price of that particular stock? It's going to jump up. Okay, this is the thing. That's what we look for when we're trying to find those kind of issues. Warren Buffett tells us that he buys great companies when they're on a surgical operation table. Okay, when they have some issues, there is certain operation going on, but they know this surgeon is good and they're going to fix this, and it's going to recover.